Hey guys, welcome back to the channel. Now, since this is a finance related channel, I thought I'd do a few videos on one of the most talked about financial markets at the moment, the foreign exchange or Forex market. So this is the first in a series of videos where we explore everything that has to do with the foreign exchange market, who the major players are and how they interact with each other. This will not be your typical foreign exchange video. I won't be telling you why you should or why you shouldn't trade Forex. These are purely to inform and help you understand and gain a better understanding of how the Forex market works, so that if you do decide to trade at some point in the future, you'll be in a much better position to do so. And even if you have no intentions to trade and you just want to up your finance knowledge on how the Forex market works, then this video will be very useful for you as well. So what is the foreign exchange or Forex market? Well, it's a market on exchange where companies and individuals trade currencies. In other words, it's a market where they go to buy and sell currencies, just like you would go to your local market to buy and sell goods. Now, it's by far the largest financial market, with a daily average turnover of $6.6 trillion in 2019. That's roughly 50 times larger than the equity markets, which is the market where you buy and sell stocks and shares. Now, most people have a good idea of how the stock or the equity market works. However, the foreign exchange market can appear a little more abstract, and that's because it's a lot easier to understand why a company's value would increase. However, understanding why one currency would outperform another isn't as straightforward. Now, unlike your local market, there is no one physical location for the foreign exchange market. You can't simply type in foreign exchange market into your sat-nav and expect to get directions to the foreign exchange market. Most likely you'll be redirected to a post office or to an outlet where you can exchange currencies, most likely for travel purposes. It's a global decentralized market where technology like the internet allows the market participants and players to interact and deal directly with each other from anywhere in the world. And it truly is a global market operating 24 hours a day, every business day. The players or the participants range from your multi-billion-dollar investment funds to your small individual trading on their own account or simply exchanging currencies to go on holiday. International trade would be impossible without the foreign exchange market, and given the globalization of the world economy, it's becoming increasingly difficult to insulate yourself from what happens from a financial or economic point of view in other countries. Even if you invested in only domestic companies, chances are if these companies are large enough, then they'll have employees or suppliers that they'll have to pay in a foreign currency, or if they sell their products abroad, then they'll be generating revenue in that foreign currency. So they would be exposed to the financial exchange rate, and you, since you've invested in those companies, you'd have an indirect exposure to those rates as well. Since we're at a market, even if it's a virtual market, and talking about buying and selling, then we have to talk about price. Yes, even money has a price, and in the Forex market, it's often expressed as a currency pair quote. So you'll see two currencies and one price, which represents the price of one currency in relation to the other. For example, if you're looking at the US dollar and the Great British Pound pair, then a quote of $1.29 means that for every pound that you exchange, you'll receive $1.29. And this is very similar to what you might see if you go to a currency exchange kiosk when you're traveling. And if you are very observant, you will notice that there is often two quotes for the same currency pair. A price if you are buying that currency and a price if you are selling that currency. And these prices are often different. The difference between these two prices is known as the bid-ask spread, and this is how the middlemen, so the brokers and the dealer banks, make their money when we exchange currencies. It can be a bit tricky to understand at first, so let's take a quick example. So let's say you're based in the UK, you're traveling to America, so your domestic currency is the pound, the foreign currency is the US dollar. Now, the bid price determines how much of the foreign currency you will receive when you exchange 1 unit of your domestic currency, and the ask price shows how much of the foreign currency you need to exchange in order to receive 1 unit of your domestic currency. So if we have a bid-ask spread of 1.29 and 1.3, this means when I'm exchanging my pounds into dollars, for every pound that I exchange, I will receive $1.29, not 1.3. And when I'm exchanging my dollars back into pounds, I now need $1.3 to get a pound as opposed to only 1.29. And this is why there's no such thing as true commission-free currency exchange. That's actually very misleading because they have control over how wide this spread is. So their commission is already baked into the prices thanks to this spread. So you need to be really careful, and it does pay to shop around because you might find a company that charges commission actually has much better exchange rates. So you could be better off going with them as opposed to a company that states that they don't charge a commission, however their exchange rates are very bad. You often hear about a currency strengthening or weakening in relation to another, and this is illustrated by a change in the currency pair quote. So if you see the US dollar, Great British Pound currency pair quote go from 1.29 to 1.4, this means that the pound has strengthened in relation to the US dollar. So in other words, if you exchange your pounds into dollars, and if you assume that inflation and the price of goods and services hasn't changed, then you now have more dollars for your pound, which means you can now buy more goods when you travel to America. In a later video, we'll go into more detail on what can affect the foreign exchange rate of a particular currency pair. So who are the major players and exactly why do they use the foreign exchange market? Well, there are two main types of transactions. You have your global trade transactions and you have your capital market transactions. Your global trade transactions involves everything to do with buying and selling goods abroad, whereas your capital market transactions, this is where investors are exchanging currencies to move funds in and out of foreign assets. And these assets can be physical, such as real estate, or they can be financial assets like stocks, shares, bonds, etc. Businesses, in order to carry out their daily operations, they may need to pay or receive a certain amount in a foreign currency. So as I mentioned before, they may have employees or suppliers working abroad, so they'll need to pay these guys in that foreign currency. And if they're investing in assets such as building a new factory, then the cost of that factory would also have to be paid in that foreign currency. And likewise, if they're selling their goods and services, then they'll be generating income in that foreign currency. So again, at some point, they'll have to take part in the foreign exchange market to exchange these currencies back into their domestic currencies. Now, for these companies, there's also a very important use of the foreign exchange market, and that's as a risk management tool. So if they know, for example, that they have a very large order that they need to place in the future, then to protect themselves against an adverse move in the foreign exchange rates, they can enter into a foreign exchange transactions to do just that. And we'll go into more detail on how they do that in the next video. Governments take part in the foreign exchange market to help maintain embassies and military bases abroad and to make purchases such as for military equipment. Central banks also participate to help stabilize their domestic currency and to preserve the value of their foreign exchange reserves, which is simply cash that a country holds in a foreign currency. So for example, China holds over $3 trillion in reserves. We've mentioned the individuals who participate in the foreign exchange market, whether it's simply exchanging currencies to go on holiday or making purchases online from a company based in another country. You have your investment funds who are buying and selling assets such as bonds and stocks and shares in foreign currencies in order to achieve a positive return on their investments. And of course, you have your dealing banks such as HSBC, Deutsche Bank and Citigroup who facilitate all of these Forex transactions and sell Forex products to their clients. For all of these participants, unless you are providing a service or have a genuine need for the currency, then you are playing the role of a speculator in the Forex market. As a speculator, you are buying and selling currencies with the view to make a profit based on where you think the value of that currency is heading, either up or down. And the vast majority of Forex day traders fall within this category. So that is the foreign exchange or Forex market in a nutshell. Now that we understand the purpose of the Forex market and who the major players are, in our next video we'll look at exactly how you trade in the market and the different types of trades available. Thanks for watching. I hope you found this video useful. Be sure to hit that like and subscribe button and to share with anyone you think would be interested. Any questions, leave that in the comment section and I'll see you next time.